The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How are you doing, Guy?
Pretty good. You getting tired of all the political minutia going on? It looks like it's going to be Bernie and Trump.
No, please
in the general.
Please don't say it.
You know, I had to do some homework again and look up what super delegates were.
Oh, yeah.
You know, they were talking about the Democratic Party, and I guess no matter how many votes Bernie gets with Hillary having the super delegates, or with the DNC allotting the super delegates, that there's really no way that Bernie can win that deal.
It's hard for me to choose between those two winners.
I was hoping for a good socialist.
Anyway,
enough politics.
Oh,
yeah.
I know this is a financial show and about investing and all that kind of stuff, but I want to give a warning to people out there. I think my Amazon.com thing was hacked this week. It's a little scary.
Oh, yeah?
Apparently, I returned a bunch of items that the UPS guy knows my house. My wife is a very big shopper.
Amazon Prime, that deal?
Oh, yeah. And they returned something that I didn't return and used the gift card balance to buy a bunch of books for some person I didn't. And it's how to use a grenade launcher. The one was a so-and-so soldier. I'm like, holy moly.
How to build a nuclear bomb, stuff
like
that.
Like, oh,
gosh.
And I called them up and they said, well, are you sure? No, I didn't order them. I said, you need to look. That's terrorist or something. Oh, isn't that something?
You know, I know losing your identity can be a mess, but you know, the stuff on the internet that some of the older people are afraid of, usually you're covered. I had a guy try to rip me off years ago for $500 on PayPal. They reached in, took the money out of his account, gave it back. Credit cards, right? You're not liable anymore. But that identity thing, that can mess you up.
Oh, yeah. Apparently I'm ordering a bunch of how to use grenade launchers and everything. I'm like, what?
Hey, you may get that all sorted out and get your Amazon account back, but you'll never come off the FBI list now.
No, it might be that sleeper cell next door to you.
That's right. Yeah, we do. That's another story.
All right. Remember, for those of you new to the show, we developed this show to answer your financial questions. I hear this every week. I heard it twice this week. They say that if you can get 10, 15 minutes of good advice out of any radio show, that's a miracle. You guys seem to give decent advice throughout most of your show. And that's really what we're here to do.
You know, and the shows have 4 or 5 segments because the stations have commercials and that sort of thing. And the few that I've listened to kind of see what's going on with the competition and who's out there, it seems like it's the same stuff every segment, every show. Which
come to my seminar, what I did 10 years ago.
I told everybody to get out of the market. I saved them all, that deal.
Well, or it's one of those that we can get all your money tax-free, make a great return, you never have to worry, blah, blah, blah. Usually a bunch of BS. But remember, our philosophy here is there's nothing wrong with any kind of investing. It just depends on how risk tolerant you are, what your objectives are, how much time horizon you have. It really does. Anybody that tells you the stock market's a casino, it's evil, they're trying to sell you something else. Anybody tells you annuities, that's the devil's work, they're trying to sell you something else. Always look at their agenda. Like I said, I love Mr. Ken Fisher. Why I hate annuities, why should you? Because he sells something else. And everything that, that's evil associated with it, that's ridiculous. Investments are fine on any level, as long as they're, now remember, even private investments, what I never recommend for the average person, but for a certain private individual very much in the know and he's part of putting them together, that's a little different than them trying to raise money for a private investment from you, Joe Public. It's a little different there, but most of the time there's an investment for everyone, but you really need to know the details and the pros and the cons. And the problem I always see is salesmen out there they'll definitely tell you the pros. Now they may even stretch those pros.
They may not even realize they're doing it. They do it so often.
Sweep the cons under the rug. Oh, yeah, there's risk here, but you know that's not going to happen. Look at our rolling 10-year period. Look at how we did. Worst case, we've made 14,000% a year. Come on.
Trying to assess the market right now, and if you watch any of the shows, everyone's talking about it. The Fed, what's going on, rates up, rates down, international. Market did okay this week. It's been up and down quite a bit this year. And I ran across one of the economists being interviewed, and it was an interesting fact. Said the market had not reached new highs for 9 months, and they were trying to decipher whether we are in a bear market. Is a bear born was kind of the topic of the subject. But it was interesting. It's only happened a few times, 13 times since 1928, the crash, and 9 out of those 13 times, it absolutely was a bear market. But the point is, and what they were trying to make, and food for thought, is a bull market really doesn't pause, right, for 9 months and then take off again. Now, as soon as you start buying into all that and changing all your positions, it'll do something that you don't expect. But I thought that was interesting. And they started to talk to the economists a little bit more, and they were asking them, what do you project? What do you think the growth is going to be over the next 5 or 10 years? The last 15 has been pretty slow. And he said, well, I think, it'll be about a 6% growth, based on all the numbers and all of that. And they asked him what they thought the volatility would be. And he said, well, I think the swings will be about 10 to 15%. So right now, the risk reward, you were talking about risk tolerance, the risk reward is kind of out of kilter because of the volatility. We don't know what the return is going to be, but use his number, maybe a 6% number with 10 to 15% swings to get that 6%. Now, if you're not drawing money out of your account, that's okay. But if you've got to draw out on a 15 or 10% downswing, it's painful.
Well, it can be a death spiral.
Yeah.
Anytime you're taking money out in a down market, that's why the experts that say you should do stock market only will say, well, you need to adjust what you take out of the market. And that's fine if you're not retired. But I'd like you to call the electric company, see if they'll adjust your bill because the market's down.
Based on the market.
Right.
Yeah.
You mean, in other words, you got $1 million, you're taking out $40,000 a year. Well, the market's dropped to 500,000. Now you're supposed to take out 20,000 a year.
TXU, I'd like to have your market adjusted plan. That stock market adjusted bill, please.
And that's why I tell people, anybody that says just the stock market, well, that can't be for everybody. It depends on how much income you need. Everybody else asks me, do I have enough money for retirement? Well, it depends on how much you're spending.
That's right.
If you're spending very little, you don't need as much. If you're spending a lot like, some of us, then you need a whole lot, right?
That's right.
All right. We're going to go over your financial questions today. Remember, whenever I get a question that appeals to a broad audience, these are coming in from clients, from potential clients, from callers from the radio show. People send me emails. I want to share them with you because when they have broad appeal, I think we can all learn something from them. So let's go ahead and start with the questions. What's the first one, Guy?
Well, it's kind of like what we were talking about already. I hear all you financial guys talking about risk tolerance. How do I know if I'm risk tolerant or not?
Well, there's a lot of different tests you can do, risk tolerance questionnaires. And this is typically, you'll find them mostly in a registered investment advisor environment. Remember, we are our registered investment advisor. So in order to act as your fiduciary,
that's the word,
we have to ask you a bunch of questions. It'll ask you about the similar things in like 5 different ways. First, it'll say, how much can you stand if the market went down? How much risk? How much would you like to return? The funny thing is, usually they say, well, I'd like double-digit returns.
That's right.
What's the worst thing that happened to you? Well, it was losing a penny, of course. I don't want to lose anything.
I won't lose a thing.
So really, you're not risk tolerant. You just want great returns, but everybody does. But in order to get great returns, a lot of times you have to take some risk. But they'll ask you questions several different ways to see if you're risk tolerant. On a broad sense, remember, if you can't take any risk, you're not risk tolerant. If I've got a $500,000 portfolio, and if I saw it go down $10,000 and it freaked me out, and I moved to Chile or something, well, you're probably not risk tolerant. But now conversely, okay, I could stand it. People will tell me all the time, no, I'm very risk tolerant. If it went down 20 or 30 grand, and I'm like, well, how much do you have? $1 million. I go 2 or 3%. If it went down 2 or 3%, You're not risk tolerant either.
Now you're connecting the dots. That's the key, and we'll use $500,000. If it goes down 5,000 and you're okay with it, that's a 1% swing, right? If it goes down 25,000 and you're a little bit uncomfortable, but you're still going to hang in there, if it goes down 50,000, which is 10%, and you're really feeling the pain, I mean, that's a good way to judge it. What percentage of a drop can you just let things ride and not sweat?
Well, think about the last few months. We went through a 10, 15% drop.
Absolutely.
If you had $1 million, you could have lost a couple $100,000. If that didn't bother you, you're risk tolerant.
You're strong. You're that strong.
I mean, I think it's natural as you get older to become less risk tolerant, but it's not always the case. I've seen some 70-year-olds that are very risk tolerant and some 30-year-olds that aren't risk tolerant at all. So anybody tries to throw the old age-based stuff at you, that's not necessarily the case. If you have any questions about your risk tolerance you'd like to give us, we can send you one of those questionnaires. 972-715-2424. Again, 972-715-2424. You can go to our website, ilovemyretirement.com. Stay with us, folks. Get a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Today we're going over your financial questions. These are questions that have come in from our customers, the prospective customers, radio call-ins, emails.
Right.
Yep. Anytime we find one that appeals to a broad audience, we're going to share them with you. All right, what's our next question?
And a lot of times the questions will be very similar, if not the same, but we'll get them out there again because enough people are still asking that they probably didn't hear it the first.
Yeah, we get a lot of similar ones. We try not to put them together, but it happens a lot. We'll get depending on the time, what the market's doing, we get a lot of similar ones.
Sometimes we'll get a question that we answered the week before, the very next week. So anyway, all right. I'm starting a 401k for my small to medium-sized company. Which 401k providers do you recommend?
Are any of them paying us at all? No? Okay.
No, let me check.
No.
Soft costs.
No, no paid people pay us for any advertising. What kind of radio people are we, right?
For the #1 radio show. Come on, man.
All right. 401ks, it used to be that when you had a 401k when you're starting one out, nobody wanted you. Now, the biggest 401k company in the world is Fidelity. Second biggest is Vanguard. And they're both excellent 401k providers. The problem is, if you don't have at least $1 million, $2, $3, $4 million in the plan, they don't want you. Not yet. They'll like you later. But not yet. Because they offer a lot of low-cost solutions. They've got the really good websites like 401k.com, all that good stuff. And I love them. I've used them a lot. But when you're in a small business trying to start one, that's when you come in the issue. It used to be you were relegated to the group variable annuities. And even though they're not as pricey as the retail variable annuities, which are ridiculous, they're still pricey. And so even though you might not have paid any extra fees as the company owner, your participants, your employees, might have been paying 2% a year, on their mutual fund purchases. And that's how they pay for the plan. And that's how they'll take, we won't take anybody under $2 million for Mr. Fidelity or whatever, right? But you're just starting a plan out for 2% a year. We'll open it right now, baby. So that's what they do. But times have changed.
Yeah.
And there's been a lot of legislation passed and everything else to make it more fair for 401k participants.
You're talking about top heavy and all that.
Yeah, there's all about the costs of it, the cost of the plans. And so there's some good ones. Share Builder 401k is a pretty good one out there. And they're pretty cheap. It's all ETFs. Now, their ETFs might be a little more expensive than like a Vanguard ETF because you don't have the several million, but maybe you get it for 0.5% instead of having to go the old variable annuity route where you're talking about 2%.
And that's an inexpensive variable.
Oh, yeah. And setting one up, I think, is like $1,000. It's not bad. You can set up small 401ks and still have an ETF portfolio, and it's not bad at all. It's not bad at all. So that's where I would look at a place like Share Builder. Once you get big enough, you might want to look at some of your Vanguards. Some of the other ones have big names. I'm not going to mention them. I'll mention them if I like them, right? And so they don't sue me. I'm not going to mention them if they don't. But some of the big names, just beware. because they're still charging retail mutual funds and a 401k, even if you have 500 employees, too onerous.
And there's hidden costs, all sorts of things.
Yeah, you don't want that kind of stuff. So 401ks can be done for small companies for minimal cost nowadays in comparison to even 5-10 years ago. So look those up, but make sure your employees aren't paying too many fees. Make sure they're in the ETFs or have a lot of index funds. It's okay to have a couple of retail funds in there, but remember my 401k advice is stay away from the target date funds. Even though they're extremely popular, they're probably the most popular part of 401ks nowadays. In other words, remember Fidelity 2020, all these different ones.
It's a sizzle. It's marketing right now. It's in. It's hot.
Well, it's easy. You know, you just put your money in there. I know I'm going to retire about this date, and boom, it worked. The problem with those target date funds in 2008, the 2010 target date funds lost an average of 40%. So wait a minute. I was supposed to be safe. This thing is supposed to be safe. I'm going to retire in a year and a half.
That's exactly.
And they lost 40%. That's not what is that? I'm supposed to retire regardless of what happens to the market. And so that's why I'm not a big fan of target date funds. You need to allocate it yourself. Do a little more homework, a little extra work. I know it stinks, but you got to do it when you get closer to retirement. Don't try to get a one-size-fits-all deal. All right, what's your next question?
Yeah. All right. I've been with my CPA for over 20 years. He is starting to manage money. Since he already knows my situation, wouldn't he be the best person to manage my assets?
Well, if somehow he just got 30 years experience in actually managing money instead of doing taxes.
Wait, now you've done your own taxes for year after
right.
year after year. Maybe
I'm a
we
CPA,
should,
right?
Maybe we should start doing taxes.
I know there's a difference between taxation on investments or taxation, personal taxation or business taxation, and how to manage a portfolio. Also, how to manage a portfolio effectively as far as tactical management versus, you just got to make sure there's so many different aspects to managing your money that people aren't aware of. Just because you're good at picking mutual funds or picking individual stocks or you follow dividend-paying stocks, there's a million other things in this business that you have to know when you get to a certain point. Somebody told me, well, I've always managed my money. I said, well, that's great. If you have the time, expertise, and the risk tolerance.
Desire, absolutely.
Nothing wrong with managing your money. I go, but you've seen one situation, right? Your own. A seasoned advisor has seen 1,000 situations, 1,000 people retiring and knows what is happening. They're able to show you what you don't know could happen or is about to happen.
Well, and just think about all the intricacies in the tax code that these guys are experts on. Same thing in the investment world, but they're not experts like they are in the tax code.
Yeah, everybody tries to, put all these hats on. And usually you just do everything badly if you do too many things. But stay with us, folks. Don't hesitate. If you have a financial question, like to take advantage of our retirement analyzer, stress test, or Social Security optimizer, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. I'll be happy to email me at victor@victormcclure.com. We'll be right back after the break.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're going over your financial questions. I was going to go a little bit more of that last one. It was, are CPAs good at managing money? Well, obviously it depends. But typically, CPAs are good at taxes. And taxes on investments or personal and business income taxes, there's very little correlation between actually managing money and investment.
And there's a lot to it. Just like with the CFP, taxation's a real important part. Estate planning's a real important part. Investing's you got many, many facets for the CFP. Don't get us wrong. We use CPAs, your CPAs. We use estate attorneys, yours, or we have some good ones that we use on our estates that we work with to make sure that everything works tongue and groove so you get the best outcome. We like working with them, but everyone has their own thing. It's kind of like you could take it a step further. I've got an estate attorney. Should I use him for an investment manager? I've had people come to me, take our proposal, our plans to their estate attorney and said, hey, we're looking at this. You go, oh, no, you don't want to do it. I can do that for you. And then they take the same plan that you just gave them and implemented them. So that's not right either.
Right. You just got to be very careful. Remember, specialists are usually for some things important. If I've got a common cold, I'm going to my general practitioner. If I got lung cancer, I'm probably going to the, somebody that specializes in that, right?
MD
No, they're not
Anderson.
an oncologist that specializes in lungs. But I think with your finances, if you're just starting out, it's less important. It's still important, but it's less important. But if you're about to retire in 5 years or already retired, it's really important. You might want to go to a specialist.
That's a good point. Can an oncologist do cardio surgery? Probably.
Sure. A general practitioner could. I'm sure they went to school for it.
They
Could have
could,
been a
right?
long time ago, but yeah.
Not probably the guy
Right.
for me, but they can
We've
do
both
it.
taken the the CFP taxation part. That doesn't mean I can do taxes.
That's right. That's right.
All right. What's the next question?
All right, let me look here. A problem too few have. I have too much money in cash.
All right.
Do you have any suggestions for excess cash? Actually, right now, I bet there's a lot of people sitting in cash.
Yeah. Cash is important, but having too much of it can make you lose to inflation, obviously. You just got to be careful with cash. Don't think something is cash when it's really not. Sometimes people try to sell stuff that's really not cash or money market oriented. Stay with your traditional stuff. If you don't want any risk, stay with the stuff that doesn't have risk, or less risk, less market risk.
Well, and
Buy a government bond for 10 years, something like that.
and cash should be looked at really as one piece of the puzzle. Now, right now with the market volatility, many of our listeners, many of our friends, perhaps ourselves, have too much in cash because we're couching it there.
That's right.
Now, in fact, we may be losing money because the fees are more than the rate we're getting. But you got to look at it right as a whole picture, not just the cash. You got to make sure, as we talk about, the income needs are taken care of, the inflation needs are taken care of, the kids' college needs are taken care of. You got to have cash. We always talk about how important liquidity is in planning. It's very important. And unfortunately, as we always say, it's very expensive. Why? Because you don't get paid much for it, but you still have to have it. It's one piece of the big puzzle.
Just make sure you're not waiting. You're putting everything in cash and you're waiting for this hyperinflation that you heard on the radio or something.
Right.
It ain't coming, and you'll just be waiting a long time. You'll be that blue guy in the corner. You've heard that one.
Holding his breath.
Right.
That's right.
And so there's a couple things right now that aren't bad. Like you can get some fixed annuities, 3% for 5 years, and that's a tax-deferred, judgment-proof 3%, so it's better than a taxable
And if you go over
2% at the bank.
if you go over 250,000, you get a little bump up in rate.
Right. I mean, those aren't bad. I wouldn't do 10-year treasuries right now, even though they're definitely an option, but I think it's 1.6%, 1.7. Not great for a 10-year tie-up, But you got your normal stuff, your CDs. But anything that's beyond those types right there, you've got risk. I hear this all the time, that people get dividend-paying stocks and think they're not at risk, or think they have a lot less risk than regular stocks. They don't. You can go to one that's S&P 500 Aristocrat Index.
Right.
Takes the top 40 dividend-paying companies that have increased dividends for 25 years in a row. Now, that's got to be safe. It's not.
Except for this year now. They're coming down.
Yeah. Dividends have steadily came down for, 30 years. There's no guarantee the dividends will keep paying. The stocks themselves, which you have most of your money in, can go down to nothing because a lot of people are just buying them for the dividends. So if the dividend drops, they stop buying them or sell them.
It's a great opportunity for the financial analyzer, which goes through all of that stuff
Right.
for our listeners.
I mean, what we try to do is we take your situation and we plug in all the numbers after we put in inflation, and we see, okay, is there a potential problem down the road that you might not be aware of? Did you realize if you've got 5,000 a month bills now that you won't have 5,000 a month bills 10 years from now, unless the electric company is going to start lowering the rate, insurance companies are going to start lowering their premiums? I don't think so. You got to factor in all that stuff. You got to factor in, if you got a retirement account of $1 million right now, is it going to be $1 million when you're 80? No, typically not, because of required minimum distributions. You have to factor in all that stuff, and our plan does that. Don't hesitate to call us if you'd like to take advantage of our complimentary retirement stress test and retirement plan. It's 972-715-2424. Again, 972-715-2424. Or you can go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Today we're answering your financial questions. Remember, we've been financial advisors for I've been about 30 years. What am I talking about? About 30 years. We have more credentials and licenses than anybody I know. But we're very conservative. We like certain things. We have certain strategies that we use. Like, let's say you've got you want a retirement plan. Well, we like the bills paid. I don't like gambling whether the market goes up or down or if interest rates are going to be a certain level. Do I get to pay my bills? If I got 10 grand a month in bills, I like 12 grand coming in. And then what I like after that, I like the stock market. I think the stock market is a great place to cover inflation over time, but it can't be in place of the bills.
And the reason for that is once your bills are taken care of, it's not gambling, really. I mean, because you've gotten that taken care of, it's secured. Now, we know that there's risk associated with it, but it's acceptable because the bills are taken care of.
Consider it a retirement paycheck. Your employer paycheck stops, and your retirement paycheck starts.
Who would work if you could continue to get a paycheck?
I need one of those right now.
Kind of like socialism, isn't it?
So retirement paycheck, that's what consider it. If you're worried about the market right now, you need to call us. We've got some strategies that can help you. If you're worried about retirement, not having enough, call us. We have some strategies that can help you. If you're looking at options, in other words, what you're in sounds pretty good, but you'd like to look at options, don't hesitate to call us. Our number is 972-715-2424. Again, 972-715-2424. You can go to our websites. I'll go to this ilovemyretirement.com, victormcclure.com, DillonGageWealth.com. There's a bunch of them.
Same thing, too. A lot of our listeners, you know how much money you have. You know approximately when you want to retire, but you may not be able to put it all together and know with your amount of money, with your time frame before you retire, how much income can I get? I mean, it's a harmless question. It's easy to answer. No obligation. We could put that together and at least give you a number.
I did a Social Security analysis this week that showed a person getting $500,000 more on something they weren't aware of.
That's crazy.
Over a lifetime. That's craziness. All right. Remember, that's all complimentary, no obligation. 972-715-2424. All right, Guy, I'm going to ask you this next question.
Good. Let's do it.
All right. Federal Reserve Chairman Janet Yellen on Thursday, I guess this was probably a couple weeks ago, I remember, said the U.S. Central Bank is studying the feasibility of pushing short-term interest rates into negative territory. Should the economy need a boost, right? What effect will that have? Negative interest rates.
I tell you, just the fact that they're talking about negative interest rates, what does that show you? It shows you that the Fed doesn't have much ammunition left, does it? Once they get down to zero, and you get on that candy or that crack almost, right? Because it would stimulate it, and then eventually you get to zero. What do you do? Well, a couple of things. First off, I think like most people, when you hear negative interest rates, you think automatically, does that mean I'm going to have to pay the bank to hold my money? And although the fees on your account versus the interest rate, you may be there now, but that's not what it means. What negative interest rates are for is to stimulate the banks to not leave their money on deposit with the Fed. If they leave it on deposit, they're the ones that have to pay. And the reason they would implement negative rates is to encourage the banks to get the money out and get it in circulation. You and I have talked about it a number of times, Victor. The European banks and Japan have tried this for quite a while, and it hasn't really worked out well. Negative rates would, and this is an opinion, but would crush net interest margins for banks, and it may put us in the midst of a kind of a global currency. Excuse me, can't get it out. Put us in the midst of a global currency war. So there's a lot of negative things associated with negative rates as well. Just
think about it in a broader sense. The reason why they lowered rates, right, is to get things moving. The government doesn't care about savers. They don't care about if you're making any interest on your CD.
Pensioners.
That's right. What do they care about? If people are moving real estate, people are buying, selling real estate, that gets the whole industry moving, right? The construction people, everybody's moving, right?
Fueled, that's right.
Everybody's, people are buying stuff on credit cards. They feel good. If the stock market's good, they feel good. So that's why they do these kind of things. Also, businesses can expand their business because loan rates are so much lower. But what happens is you keep them low. They kept the interest rates at 0% for so long, and they still aren't going out there. The banks are still holding on to cash, have more cash than they've ever had in history. So then they try, let's start charging their butt for not loaning money. How about
right.
that?
We'll stimulate it.
So that's where you get Now, people say, well, that's the end of your economy. No, Germany's just done it recently. A lot of European, Japan did it forever, right? Didn't wreck their economy.
Think about it this way. Look how difficult it is for us to get up from zero back to normality. They talked about it every day, every week, every month. When is the Fed going to raise rates? When are they going to do it? They finally did it at the beginning of this year, and they had a plan to do it 4 times consistently this year to get some normalcy out of it. And as soon as they raised it one time, 1/4 of a point, things went crazy. So the point is, we're having a heck of a time getting up from zero back to normal rates. Can you imagine if it was negative, the difficulty we'd have? What do you go to, double negative?
No, I hear all this time that our debt is so high it's going to be 30% of GDP. Doesn't that have to raise interest rates? They really don't have anything to do with each other, unfortunately. They can't keep printing money, and it just doesn't have anything to do with each other. I looked at the historical inflation rate the last 30-something years.
Right.
It's still only been 2.5% or so. So they can keep rates low, and they can keep a pretty good lid on inflation, except for medical inflation, like health insurance. They can't keep a lid on that no matter what they do.
Now you're opening up Pandora's box there.
Remember, folks, if you have any financial questions or you'd like to take advantage of our complimentary, no-obligation retirement analyzer, retirement stress test, Social Security optimizer. Like I said, we just said this week, we showed a couple how to get $500,000 in extra lifetime benefit by one simple thing. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Our staff has told me a question I might want to talk about because we're getting a lot of calls this week on a lot of people wanting second opinions on either their portfolio or an investment strategy they've looked at. I got a bunch of calls personally this week on similar things. Yeah, absolutely. We love doing that. Remember, there's no cost or obligation. But sometimes some of the stuff you hear out there, it just isn't real. It's not right. Or you're based on some kind of rolling 10-year averages, and they cherry-picked a few mutual funds, which they didn't even own those funds for that period of time.
No, and you got to feel comfortable with your advisor and be on the same page, and you got to share the same philosophy. There's many philosophies. Ours is not the only one that's right. Although we think it is.
Right.
But
we have gone 30 years without a single complaint.
That's right. But there's many successful philosophies, and obviously you want to find an advisor that you share a philosophy with. Having said that, I've had a couple of people this week myself come in that went to some other well-known seminars, and just their philosophies didn't match.
Right.
And we ended up working with them. I know that you're working with a guy was working with a big national guy.
Right.
And he's probably going to have you advise him. I'm also working with, and had for a client actually many years, an assistant of one of these big guys here locally that everyone would know the name on the radio. So anyway, you want to match.
It's always funny when you get the employees of
I know.
become your clients.
I'd just love to say the name,
No,
I won't, but I won't. But the whole point is a second opinion.
Right.
Not only do you get a second opinion on your portfolio and is it going to work for you, but you also kind of get a second opinion on the philosophy, and do you connect with your advisor?
Right. They obviously have to be competent. You got to have experience. Even though a 20-year-old might be a brilliant, theoretical knowledge might be out the roof. He might be an Ivy League guy. They have no experience, no practical knowledge. And I don't want anybody learning on my money. But that's just me.
And that 20-year-old's philosophy is going to change over the next 30
Oh,
years.
yeah.
You know it is.
You got to be beat up, bloodied, blah, blah, blah. It's just like a boxer. You hit him in the mouth enough times, he'll start ducking, right? Wait a minute. Let's avoid that particular thing.
That's a pretty good analogy. I like that.
And so we've already been through the wars. We started out just like everybody else, the old stockbroker type, the old commodity broker, calling people on the phone, smiling and dialing. Boy, that was wonderful. Thank God that was a long time ago, right?
I'm kind of glad I'm not 20 anymore.
Make 1,000 calls. He hung up on you, call him again. I'm like, oh, Lord, I can't do it. Yo, you can too.
Oh.
Yeah, that's the way it is. So don't hesitate to call us. If you'd like a second opinion, a complimentary retirement stress test, retirement analyzer, Social Security Optimizer would be more than happy to do it for you. 972-715-2424. Again, 972-715-2424. I think we got time for one more question.
Well, I'm looking at this next question, and it looks like one we've covered a few times, but let's do it again. Because apparently this person
didn't.
Do
the next one then. I do remember that one, I think, a couple weeks ago. Do the number 7.
Well, that person didn't hear it, though. All right, sorry, here we go. I listened to a radio show that explained that I can buy rental real estate with my IRA. Oh, here we go. So I moved my IRA to their approved IRA company. Can I mix IRA funds and other funds to purchase the properties?
Okay. I'm going to say this. Just because you can purchase real estate in an IRA doesn't mean you should purchase real estate in an IRA.
You've got custodians that'll let you do commodities in an IRA.
They'll let you do anything. You can put your grandma's old doll in a dang IRA nowadays.
Absolutely.
Here's one thing that they don't tell you. Let's say you've got a $100,000 IRA and you buy a rental property with it, right? You put this IRA over there. Let's say the air conditioning system breaks. This just happened to me last year. One air conditioner, $16,000. I almost choked. So you pay the $16,000. You're like, well, I got an air conditioner. It's a rental property. I got to pay it. Now your $100,000, you immediately owe taxes and a penalty on that. And you ask why? You have to pay with IRA funds anything to do with that property. And if you don't have any excess IRA funds, let's say, well, I can put in this year's contribution. Well, the most you can put in is what, $5,000 to $6,500. That's it.
So here's a lesson. If that person is telling you to put all of your IRA into the fund, forget the investment and whether it's wise, because that's a no-no too, kind of. But if they're having you put all of your IRA with them and you're not leaving anything in reserve for these possibilities, red flag.
Or let's say you do it, you have to make, there's an ongoing cost and you're not rented for a while. I get it. Real estate is hot now. You can get really good rental stuff. I get that. But if you've been in Dallas long enough, like I have, you've seen the rental market just completely evaporate to nothing, and you've seen it go well. Right now, we're in that high point. It looks great. And that's usually when everybody starts doing it is the time you shouldn't get out. But IRAs, let's say you've got this IRA on the house. You can't write off the taxes. You can't write off the insurance. Nothing can you write off because it's already in a tax-deferred vehicle. And so a lot of times they don't tell you these kind of things going in. And so you got to be careful. Like I said, just because you can buy rental property or investment property inside an IRA doesn't mean you should. I have had to talk people how to unwind these things, which are very difficult to do. Unwind them just so they didn't have some huge tax bill and government calls your IRA and says, all right, you put $500,000 in there. I need $250 in taxes and penalty right now. And you're done. You can't do anything about it.
And to be clear, don't commingle funds, qualified and non-qualified.
Yeah, you can't commingle funds and buy a house. That was the answer to the question. Well, that's our show, folks. I want to thank everybody for listening. And remember, if you have any financial questions or you'd like to take advantage of our complimentary, no-obligation retirement analyzer, retirement stress test, Social Security Optimizer, or anything else you like, just a second opinion, don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.